Now that we've covered the basics of investing, I'd like to talk about what we mean by value growth investing. Value growth investing is a method of investing that finds businesses with growth potential and buys them when they're good value. I've been following this approach for many years after learning about it from people like Warren Buffett and Charlie Munger. But in order for this to work, we need to understand what we mean by growth and what we mean by value. Growth in anything is simply ending up with more than you started with. So a growth company is one whose value is expected to be greater in the future, so that it could be sold for a price greater than that paid now. But deciding which companies are likely to grow in the future can be tricky, and I exclude financial companies, mining companies, and companies whose profits go up and down in cycles, because these are hard for me to predict future growth. In general, all investing is about value. We want to buy stock in a company that's priced lower than we think it's worth. The problem is, how do we put a price on that value? Traditionally, value investing was about buying a company for less than its assets were worth. This was a method that was taught by Benjamin Graham and initially practiced by Warren Buffett, but these days it's almost impossible to find quality companies that are priced below their net worth. Value growth investing is about looking for companies that have growth potential and buying them when they're good value. The value in this case comes from the fact that the stock market is not taking the future growth potential into account, resulting in the company being underpriced at present. So it's more about a misprice of the growth potential of a company, rather than the mispricing of the assets of the company. The intrinsic value is the absolute value of a company, not the value relative to other companies in the same industry, and not the value put on the company by the stock market or news story hype. In the short term, a company's stock price says nothing about the absolute value of the company. In the long term, it's to be hoped that the stock market will recognise the absolute value and provide a good return on the investor's money. So how do we calculate intrinsic value? Well, there are various models and calculations we could use, but I don't think trying to calculate intrinsic value has merit. There are way too many variables and unknowns. Instead, look at the growth factors that are important, and decide if these factors are included in the current stock price. If not, then the stock becomes a possible purchase. Also decide if too much cash is needed to provide this growth, and if so, then the stock becomes a possible pass. In other words, growth is always a component in the calculation of value, whose importance can range from negligible to enormous, and whose impact can be negative as well as positive. Another important part of making good investment decisions is removing emotion from the equation. Many investors buy on the hype in financial news and sell when things look generally bleak. This is a method that will eat away at your returns, so try not to get caught up in herd behaviour. Fear and greed are two main factors behind short-term price movements and should be removed from the investor's emotional makeup. Warren Buffett believes that markets are efficient in the long run, but highly inefficient in the short run, and these irrational prices can be exploited to earn market-beating returns year on year. To paraphrase Benjamin Graham, in the short run the market is a voting machine, but in the long run it's a weighing machine. Value growth companies are expected to grow in the future and are purchased when they represent good value for money now. So how do we find them? I use free online tools to screen the stocks of a given exchange, looking for factors that indicate good growth potential. I exclude companies that may be cyclical or in industries that I don't feel confident in understanding, and I then download financial reports for the past 5 to 10 years and analyse these in a spreadsheet I designed to check that the growth isn't going to come at too great a price. Once those checks are performed, I'm left with a handful of companies to check in more detail by reading annual reports and online sources of information about the company, so that I have a better understanding of the underlying business. I don't look at analyst recommendations, since I prefer to do my own research that isn't clouded by any potentially biased reports. In the next few lessons, I'll introduce the online tools that I use to screen and analyse value growth companies, so that making investing decisions becomes easy and stress-free.